There is a pervasive myth in the world of finance and trading. It is a story of explosive overnight success, of finding that one perfect trade that changes everything. This narrative is exciting, but it is also a fantasy and a dangerous one at that. The real path to building substantial wealth, the kind that can truly alter the course of your life, is far less dramatic. It is a quiet, methodical process built not on luck or genius, but on a foundation of unshakable discipline, profound patience, the relentless mathematical magic of compounding. This is not a lottery ticket, it is a blueprint. It is about transforming a modest starting sum, say $5,000, into $1 million or more, not through a single heroic act, but through 1,000 small intelligent decisions repeated over time. The core message is one of process over outcome. So many people chase the outcome, the $1 million account, and in their haste, they ignore the very process required to get there. They gamble when they should be strategizing. They hope when they should be executing. This approach is different. It starts with the simple, powerful idea that small consistent wins, when stacked one upon another, create a momentum that is almost unstoppable. Before you entertain a single thought about making money, you must first become obsessed with not losing it. This is the paramount rule. Protect your capital at all costs. Your trading capital is not just money, it is your primary tool, the lifeblood of your operation. Without it, you are out of the game entirely. Therefore, your first and most important job as a trader is not to chase massive profits, but to rigorously defend your account from significant drawdowns. You are not a treasure hunter seeking a giant score. You are a guardian, a protector of the assets you have been entrusted with. Great traders are not defined by their biggest wins, but by their ability to manage their losses. Taking small, controlled losses is an inevitable and necessary part of the business. A professional defines their maximum acceptable loss before entering. If price hits it, they exit. No questions, no hesitation, no emotion. It is a simple, mechanical action. This discipline requires a radical acceptance of being wrong. A small loss is simply market feedback. One single catastrophic loss can wipe out the progress of dozens of successful trades, born from stubbornness or a refusal to admit a mistake. It can cripple your account and your confidence. Before you click the buy or sell button, you must know exactly where you will get out if the trade goes wrong. This is your stop loss. It is not just a suggestion, it is a contract you make with yourself. One of the most common and costly mistakes is trying to be a hero, predicting exact reversals, bottoms, and tops. This is a fool's errand. The market is a powerful, flowing river. Trying to predict its turning points is like trying to catch a falling knife. A simpler, safer, more profitable approach. Identify the direction the river is already flowing and go with it. This is the essence of trend following. In an uptrend, higher highs and higher lows, the odds favor looking for buys. Momentum is on your side. In a downtrend, lower lows and lower highs, the path of least resistance is down. Look for sells. Your job is not to catch the very beginning or the very end. Capture a piece of the middle, the meat of the move. It is acceptable to be a little late and to leave a little early. Define trend systematically, not on feelings, not on news, not on gut. Use objective chart evidence like price relative to a key moving average and apply your rules consistently. Once your system signals a clear trend, seek low-risk entries in that direction and ignore counter-trend signals. Do not overthink it, just follow the flow. To effectively follow a trend, you must first be able to see it clearly. Traditional candlesticks are powerful but filled with noise, minor fluctuations that obscure true direction. Heikin Ashi smooths this. Heikin Ashi average bar uses a modified formula incorporating the previous candle, filtering choppy moves and revealing more directional structure. In strong uptrends, you will often see consecutive long green Heikin Ashi candles with no lower wicks, clear buying pressure, and a healthy trend. In strong downtrends, a series of long red candles with no upper wicks signals dominant selling. Be short or step aside. Smaller candles, color changes and wicks on both sides can signal pause, loss of momentum, or potential reversal. Heikin Ashi is not a magic bullet or a predictive tool. It is a visualization. Prices shown are calculated averages. Execute orders on standard charts. Use Heikin Ashi for primary trend analysis to gain psychological clarity while placing trades on the real-time price chart. By quieting the noise, you focus on what matters and adhere to the core principle of riding the wave. Section 5. The asymmetry of success. Cut losses, let winners run. If there is one mantra, this is it. Cut losses quickly, let winners run. Sounds simple, cliche, but most traders do the opposite. They let losses run, hoping for a miracle. They cut winners short, scared to give back a bit. This flaw blows up accounts. Create asymmetry. Average wins much larger than average losses. That is the mathematical secret to long-term profit. Cutting losses quickly is discipline, mechanical, not emotional. Use a pre-defined stop. Enter with a hypothesis. Stop loss equals invalidation. Price hits stop. The hypothesis was wrong. Close it. Take the small loss. Move on. Do not argue with price. Letting winners run needs patience and trust. Heikin Ashi helps reduce noise. Use a trailing stop to manage winners. Trail below the last two Heikin Ashi lows for longs, above for shorts. This protects gains while giving room to breathe. The trade closes only when the trailing stop is hit. Rules over emotion. Capture the lion's share of major moves by enforcing small losses and letting outlier winners drive equity growth. Section 6. The power of small bets. Why position sizing is everything. You can have the best trend following system in the world, but if you manage risk poorly, you will still fail. Position sizing answers, how much should I risk on this trade? The blueprint, risk a small fixed percentage of equity. A prudent rule, risk no more than 1 to 2% per trade. On a $5,000 account at 1%, the maximum loss per trade is $50. 10 consecutive losses, a real possibility would be $500, about 10%. You are still in the game with 90% intact. Risking 10% per trade, that same streak wipes out the account, finished. Risking small is insurance against uncertainty, and it protects your mind. No entry and stop. Measure distance. Divide your max dollar risk, say 1% by that distance to compute position size. Tight or wide stops, your dollar risk remains constant. Standardize risk across trades. This enforced consistency builds a steadier equity curve and enables compounding. Section 7. The Eighth Wonder. Harnessing the unseen force of compounding. Einstein is often credited with calling compound interest the eighth wonder of the world. Apocryphal or not, the sentiment is true. Compounding turns small, consistent gains into extraordinary wealth. As your account grows and you risk a fixed percent, your position size scales and profits generate profits. The positive feedback loop creates an exponential curve, slow then dramatic. Impatient traders chase 50 or 100% in a month, unsustainable and ruinous. The compounding model targets modest, realistic, consistent returns. Imagine 5% per month, $250 the first month, then $262.50 the second. Small at first, but the process begins. Maintain that average and mathematically 2 years, surpass 16,000, 5 years, 90,000, 10 years over 1.6 million. Not a guarantee. An illustration of principle, the path will be bumpy, losing months and winning months, but the long-term potential is staggering. Protecting capital keeps you in the game. Following trends and letting winners run produces positive expectancy. Small fixed risk scales with equity fueling compounding. Trust the process, trust the math. Session 8, the inner game, mastering the psychology of trading. You can have a perfect plan and a flawless system, but if you cannot control your mind, you will fail. Trading is 10% strategy and 90% psychology. The market mirrors your weaknesses. Fear causes paralysis and premature exits. Greed skips, stops, doubles down, and over leverages. The antidote to emotion is process, a written trading plan. Your plan must define markets, how you define a trend, entry criteria, stop loss placement, and exit strategies. In the heat of the moment, do not think, refer to the plan and execute. Log every trade, setup, reason for entry, outcome, and most importantly, how you felt. Over time, your journal reveals patterns and guides improvement. Discipline is a muscle built through practice. The trading journal is your gym. Success in trading is not about getting rich overnight. It is about protecting your capital, following a proven process, managing risk, and allowing time and consistency to work in your favor. Master your emotions, trust your strategy, and let disciplined compounding build lasting wealth. If you enjoyed this book summary, please like, subscribe, and turn on notifications for more insights on investing, trading, personal finance, and business success.